Both sides have stopped shooting.
Yeah, it's a mutual pause.
Right. That is the reality that we are waking up to this Sunday evening, July 26th, 2026. 2 consecutive days of a U.S. and Iran mutual pause. And, talks are pressing forward.
Which is huge, considering where we were just a week ago.
Exactly. But while the geopolitical noise goes quiet, the structural reality of the global energy market is about to get, well, deafening. We are entering a convergence week.
We really are. We're watching 2 tectonic plates of the energy market just, grind against each other right now.
Yeah.
On one side, you have the immediate panic of this Middle East conflict, and on the other, you have this slow, kind of immovable reality of global supply deficits.
Right, the fundamentals.
Exactly. And between tomorrow, July 27th, and July 31st, we will see which plate gives way. This week is going to answer the 2 biggest questions hanging over the uranium market simultaneously.
So, which means if you are tracking global energy flows or, holding nuclear equities in your portfolio, or even just trying to make sense of how international diplomacy rewires physical supply chains, this is the week you need to watch.
Oh, absolutely.
Because over the last month, nuclear equities have pulled back hard. Cameco, the North American uranium heavyweight, is down about 14%.
Yeah, it's been a rough ride.
And this Friday, Cameco reports its Q2 earnings for the first time since their Cigar Lake mine came back online. The data we get on Friday will determine if that 14% drop is a structural warning sign or just a heavy geopolitical discount creating a massive buying opportunity.
Oh, right.
Okay, let's unpack this, starting with the most volatile variable on the board, the geopolitical off-ramp.
And before we dig into the timeline of the U.S.-Iran conflict, I think it's essential to state explicitly for you listening, we analyze these events strictly through the lens of market mechanics and supply chains. We are not taking political sides, nor are we validating the military or diplomatic actions of the United States, Iran, or any other nation involved.
No, not at all.
Our mandate is purely to assess the facts provided in our sources and, analyze how these geopolitical developments actually impact the global markets.
Yeah, that strict impartiality is critical because honestly, the market itself is entirely agnostic. It is just a mechanism trying to price in risk.
Exactly. It just wants to know what things cost.
Right. And the risk environment we are dealing with really ignited on February 20th, 2026, when Iran's supreme leader Ayatollah Ali Khamenei was killed in joint U.S.-Israeli strikes.
Which triggered a massive cascade of escalation.
It did. And then we saw a brief pause in April, leading to the Versailles Memorandum of Understanding in June, which, was an attempt at a regional power-sharing agreement to stabilize the area.
But that completely fell apart.
It collapsed entirely on July 9th when Iran struck commercial vessels. And since that collapse, the U.S. launched over 90 strikes across Iran over a 2-week period.
Which brings us to today. Now we sit at a 2-day pause.
Yeah.
Qatar and Pakistan are actively mediating. And Donald Trump has explicitly stated he is giving these talks space.
So there's a window.
There is, but the real diagnostic signal here comes from the contradictory messaging out of Tehran's post-Khamenei leadership. Just a few days ago, on July 21st, they offered a 10-day ceasefire, while in the exact same breath declaring a full-scale war.
It's crazy. Watching that play out is literally like seeing 2 drivers fighting over the steering wheel of a speeding car.
That's a clear way to put it.
Like one faction is slamming the gas pedal to the floor with war declarations, while the other is yanking the emergency brake with ceasefire offers. How on earth does the market price in that kind of diplomatic incoherence?
Well, surprisingly, the market actually views that incoherence as proof of an active internal struggle.
Really? Like between maximalists and moderates?
Exactly. Within Iran's new leadership structure, it signals that an off-ramp is genuinely possible because the moderates have enough influence to at least put a ceasefire on the table.
Okay, I see that.
But the mechanism to get there runs directly through the Strait of Hormuz. That is the core sticking point here.
Because commercial traffic through that vital waterway is currently moving at an absolute trickle.
Right.
Insurance premiums for shipping have skyrocketed, and physical supply lines are choking.
Yeah, it's a bottleneck.
Yeah.
The probability of brokering a formal ceasefire framework this week sits at roughly 25 to 35% based on current assessments.
Right.
If that happens, the primary condition will be reopening the strait to normal commercial shipping. That instantly deflates the geopolitical risk premium that has been inflating oil and uranium prices all month.
Which forces us to look at how a deflating risk premium in the Middle East collides with the actual price of a pound of uranium oxide.
This is where it gets really interesting.
Yeah, because we have two distinct weekly price tags for uranium right now from indicators like TradeTech and UxC. The spot price is consolidating in this tight band between $84 and $87, currently sitting at $86.05. But the long-term contract price, the term price, is locked, rock solid, at $95 a pound. That $9 spread seems to be the psychological battleground for the entire industry right now.
It absolutely is. And, if we connect this to the bigger picture, the term price is the structural anchor.
The $95.
Right. It reflects what nuclear utilities are forced to pay to guarantee their supply years down the road based on physical mathematical deficits. The spot price, on the other hand, is currently functioning as a sentiment instrument.
It's just reacting.
Exactly. It is reacting entirely to the geopolitical headlines of the past 6 weeks, rather than underlying supply and demand.
Okay, so if I am a nuclear utility procurement manager and I'm tasked with securing millions of pounds of uranium to keep my reactors online, I am looking at that spread and doing the math.
You'd have to be.
Right. Like, are these buyers deliberately stalling their long-term contracts right now? Are they hoping a U.S.-Iran ceasefire will crash the spot price down to that $83 support floor so they can buy cheaper in the term market?
Yes. That behavior is a very real probability, and it explains the current gridlock perfectly. A formal ceasefire announcement would absolutely be near-term bearish for the spot price.
We'd see it drop.
We would expect it to test that $83 to $84 floor, because the fear premium just vanishes. However, if we stretch the timeline out, a ceasefire is fundamentally bullish for the structural supply deficit thesis.
Because it strips away the disruption discount hanging over the market.
Exactly.
Right now, buyers are just paralyzed, trading on headlines instead of fundamentals. But once the Middle East stabilizes, utilities lose the excuse to wait.
They do. They have to return to the table and face the reality that the $95 term price hasn't budged 1 inch.
Wow.
The underlying supply deficit remains completely unresolved. A ceasefire forces the market to stop trading on geopolitical noise and start trading on the actual math of supply and demand.
And the thing is, we won't have to guess if utilities are returning to the table. We get the hard proof this Friday, July 31st at 8 a.m. Eastern, when Cameco drops its Q2 earnings.
The big reveal.
Yeah. As the most consequential North American producer, they are the bellwether. The stock is currently hovering around $87.86, which is down 14% from recent highs.
Which is a big pullback.
It is. And analyst earnings per share consensus is widely scattered. I mean, anywhere between 26 and 36 cents.
Yeah, that massive dispersion reflects genuine confusion among analysts about Cameco's sales mix and realized pricing. But there is a glaring misconception driving retail anxiety that we really need to clear up before Friday's call.
The Cigar Lake shutdown.
Yes. Cameco's Cigar Lake operation temporarily suspended operations on July 1st due to a breakdown at the Orano-operated McLean Lake acid plant.
Which is exactly where the retail panic is coming from. Investors are looking at a July 1st shutdown and worrying about the upcoming earnings call.
But they are trading on a third-quarter headline for a second-quarter earnings print.
Right, because Q2 ended on June 30th.
Exactly. The timing is everything here. Because the suspension happened on day 1 of Q3, the Q2 production numbers Cameco reports this Friday are perfectly clean.
They weren't impacted at all.
Completely insulated from that event. Furthermore, Cigar Lake already restarted on July 15th, and Cameco kept their full-year guidance of 17.5 to 18.0 million pounds completely intact.
And just for you listening who track the physical mining process, it's worth noting why a breakdown at an acid plant stops a uranium mine in the first place.
Oh, it's fascinating.
Yeah, because Cigar Lake doesn't just dig up dry rock. The ore is so high grade, it has to be blasted out with high-pressure water jets underground.
Right, to prevent radiation exposure.
Exactly. And then it's pumped to the surface as a slurry and trucked over to the McLean Lake mill, where sulfuric acid is used to leach the uranium out of the ore. So if the acid plant goes down, the leaching stops and the whole chain backs up immediately.
It's a very fragile logistical chain.
It really is. But since production continuity is a non-issue for Q2, I assume we are looking strictly at cash flow and contracts this Friday.
Yeah, there are 3 metrics that actually matter on this call. First, long-term contracting volumes. This directly answers the question about utility stalling. How many pounds did they commit in Q2? This tells us if the utility commercial engine is actually running. Second, the average realized price. Cameco sells on multi-year contracts, not at the daily spot price.
Right, they aren't day trading uranium.
No, exactly. So we need to see how close their average realized price gets to that $86 spot market. That gap is the ultimate profitability signal,
And the third metric.
the Westinghouse contribution.
Okay, I want to push on that third metric
Yeah.
because fuel servicing often gets treated like a black box in these earnings reports. How does Westinghouse physically act as a financial buffer for Cameco's balance sheet?
It comes down to where you sit in the nuclear fuel cycle. Mining companies live and die by the spot price of raw uranium oxide. Pulling rock out of the ground. It is inherently volatile.
Very boom and bust.
Right. Westinghouse doesn't mind. They handle the next steps, converting that raw material, enriching it, and fabricating it into the actual fuel rods that go into a reactor.
So they operate on a totally different revenue model.
Exactly. They operate on long-term fixed margin contracts. Utilities pay them for the service of processing the fuel, regardless of what the underlying raw commodity price is doing.
Oh, I see.
It provides predictable, steady cash flow. When the raw uranium spot price drops and mining revenues take a hit, the fuel servicing revenue acts as a stabilizing anchor for Cameco's overall profitability.
So, distilling all of this for you, if Cameco comes out on Friday and beats expectations on realized prices, and their contracting book shows growth, that 14% pullback in the stock is validated as a classic buying opportunity.
100%.
The structural bull rally re-anchors itself, but if realized prices are weak and the contracting book is stagnant, the market has to seriously question if the utility buying machine is genuinely broken.
Yeah, and Cameco gives us the reality of supply today. But to understand why utilities are willing to sign contracts at $95 for the future, we have to examine the ticking clocks of future supply.
Because the pipeline isn't looking great.
No, it's facing severe mechanical and commercial friction.
Okay, let's start with the physical friction. Clock number 1 is NextGen Energy and their Rook-I project in the Athabasca Basin.
The big one.
Yeah, this is targeting roughly 30 million pounds a year. It has been 7 weeks since their June 30th annual general meeting. Management has over 1 billion Canadian dollars in cash, their Canadian Nuclear Safety Commission license from March, and Saskatchewan Ministry of Environment approval for site programs like the airstrip.
All the green lights.
Exactly. And they promised a summer 2026 construction start. Well, we are deep into summer, and we have heard nothing.
And that silence is actively moving markets, because the calendar in northern Saskatchewan is governed by geography, not corporate timelines. The construction window is incredibly narrow. Once you hit roughly September, the ground begins to freeze.
Which changes the entire engineering reality of a multi-billion-dollar project.
Fundamentally,
Yeah.
you physically cannot execute major earthworks or pour foundational concrete efficiently once the permafrost hardens.
It just becomes too expensive.
It's expensive and slow. Heavy machinery mobilization becomes a logistical nightmare. If NextGen does not file a 6K or issue a press release confirming major contractor mobilization this week, they effectively lose this year's weather window.
Wow.
The market will be forced to push the timeline for those 30 million pounds out into the 2030s.
Keeping the $95 term price high because that supply just isn't arriving anytime soon.
Exactly.
So NextGen is dealing with the physical realities of freezing ground, but over in Australia, producers are dealing with a totally different freeze, a commercial one. This is clock number 2.
Yeah, we saw a massive geopolitical shift on July 9th when a government-to-government enabling framework was signed, allowing Australian uranium exports to India.
Which sounds incredibly bullish on paper, right? Paladin Energy drops their Q4 results on July 22nd, reporting 4.82 million pounds for the fiscal year, beating their own raised guidance.
Great numbers.
But if you listen to their investor call, there was absolute silence regarding an actual India offtake deal.
And if you are an investor looking at Australian producers, Paladin's silence on an India deal should temper your expectations. It proves that government handshakes don't instantly equal utility purchase orders.
Right, a framework isn't a contract.
Exactly. You have to benchmark this against what Cameco did back in March. Cameco signed a landmark $2.6 billion, 22 million pound supply agreement directly with India's Department of Atomic Energy.
Real ink on paper.
Yes. The political framework for Australia exists, but the commercial urgency from producers like Paladin, Boss Energy, and Deep Yellow is clearly lagging. Utilities are buying on their own rigorous procurement schedules. They aren't just reacting to political news cycles.
So we have physical delays in Canada and commercial delays in Australia. That brings us to clock number 3, the absolute gridlock in Niger.
The African bottleneck is a masterclass in how geopolitical friction destroys supply timelines. It operates on 3 distinct layers of paralysis. First, the Coton transport corridor into Benin is closed.
This is a pure logistics trap. Niger is landlocked. To get yellow cake to the global market, it has to be loaded onto trucks and driven south through Benin to the deep-water ports on the Gulf of Guinea.
Right.
And Niger's ruling junta set security preconditions for reopening that route, and draft agreements were submitted back in June.
But without a presidential-level announcement reopening that border, the trucks physically cannot move.
They're just parked.
Exactly, the product is stranded. Which leads to the second layer of paralysis, the Somer mine. They are sitting on a stockpile of roughly 1,800 tons of yellowcake that is trapped not just by the closed corridor, but by an international arbitration ruling that prevents it from being sold or moved.
It's completely frozen. And the third layer is the regulatory quicksand. Developers like Goviec are stuck in endless renegotiations for their Matahuela project because the junta is demanding higher royalties and tighter operational control before they let anything move forward.
Just delay after delay.
And the mechanical impact of that closed corridor and junta negotiation is already showing up in the data. Global Atomic has been forced to delay their massive DASA project in Niger all the way out to 2027, partially because they can't get logistics through that closed corridor.
When you aggregate NextGen's permafrost deadline, Australia's commercial hesitation, and Niger's landlocked gridlock, it makes complete sense why a nuclear utility will gladly pay $95 a pound today.
Because what's the alternative?
There isn't one. They are paying a premium to guarantee they aren't left holding the bag tomorrow.
Which brings us back to the core mission of this week for you. We are watching 2 massive forces collide. In one corner, the geopolitical noise in the Strait of Hormuz, a 48-hour pause with a 25 to 35% chance of a ceasefire that could send spot prices testing the $83 floor.
And in the other corner, the structural reality of Cameco's Friday earnings, delivering the hard cash flow data that proves whether the utility buying machine is actually working.
It is the ultimate showdown.
But there is one final provocative variable looming just over the horizon that could upend both of those narratives.
Wait, what?
Kazatomprom, KAP, the world's largest uranium producer out of Kazakhstan. Their Q2 operations update drops next week, between August 3rd and August 6th.
Oh, wow. Yeah, they already showed a 9% year-over-year production increase in Q1. Institutional money is going to start positioning ahead of that release right now.
Exactly. Everyone is fixated on Iran and Cameco this week. But if Kazatomprom's first-half output reveals they are quietly abandoning their strict value-over-volume discipline just to flood the market and capture these higher spot prices.
Oh, man.
Yeah, next week's narrative will violently shift away from structural deficits and entirely toward oversupply.
It is always the quiet variables that catch the market off guard. We start the week watching 2 factions fighting over the steering wheel in Tehran, and we end it looking at the dashboard of the global supply chain in Saskatchewan. Keep a close eye on Monday morning's shipping data out of the Middle East, and set your alarms for Friday morning's Cameco call. Until next time, keep digging.